Action.
This is episode 1, Meeting of the Minds. My name's Andrew. This is Greg and James. We're going to start episode 1 off with the stock trivia game show. So our 2 contestants, Greg and James. Now what I'm going to do is read you off the market cap of this stock, PE, number of employees, annual revenue, and EPS. You guys have to guess which stock or company that is. So with that said, we're gonna get right into it. You're gonna be given 3 stocks. You're gonna guess one of them. I'll keep track of who's winning. Number 1, market cap 274 billion. It's a big boy. PE of 11.55. Number of employees 45,000. Annual revenue of 200 billion. And EPS, current EPS of $2.97 per share. Is this stock Apple? A, Apple. B, Chevron. 3, Verizon. Goes to James.
I'm gonna go B, Chevron in that.
How much per share?
Per share, $2.97 earnings per share. James has selected
I'll say
Chevron.
I'll say Verizon.
And Greg has selected Verizon. Bing bing, James with the win. Select Chevron.
All right, what do I win?
Okay. The prize is coming at the end of this game show. Stock number 2, market cap. This one's even bigger. 3.13 trillion. We've got a PE of 33.56.
Okay.
Employees, 29,600.
All right.
Annual revenue of 96 billion.
Okay.
And earnings per share of $1.19 per share.
What are the options?
It's a big market cap.
Number 1, A, is it NVIDIA? B, is it Energy Transfer? C, T-Mobile. Selection goes to Greg first.
T-Mobile. T-Mobile.
Okay, James.
I'm gonna go with Nvidia on that. It's a big market cap.
James with the win again. NVIDIA. He's 2 for 2. Okay, we're going into our 3rd stock. You guys look very nervous and tense.
Come on,
Market cap, again, 144 billion. Another big one. PE of 21.98. Number of employees, 122,000 employees. Annual revenue of 71 billion. And earnings per share of $6.85. Is this stock A, Caterpillar, B, John Deere, or is it C, Lockheed Martin?
I will say John Deere, Andrew. What's your guess, James?
My initial thought was some kind of defense contractor, but I feel like it could also be one of the other 2. That's a lot of revenue, though. I'm gonna go with Lockheed Martin. Final answer.
Final answer for James, Lockheed Martin. Greg, John Deere, and the answer is Lockheed Martin.
Oh my!
James Marola now 3 for
3.
3.
Oh.
This spread getting blown out here. Okay, we'll move on to our next stock. Second to last coming up. Market cap 82.9 billion. We got a PE of 8.79. Number of employees 300,000 employees. Large segment.
That's a lot of employees.
Annual revenue of 88.4 billion. And to top it off, earnings per share of $6.40.
What are the options?
Is this company A, Johnson & Johnson, B, CVS Health,
Ooh.
C, waste management. Goes to James for the first selection.
I mean, I know CVS has a lot of employees, but also like, are garbage men employees? Well, yeah. Are they counting all of those? I don't know. I might have to say CVS.
There's a lot of garbage men out there. James
I'm
goes
saying
with
CVS. I'm saying CVS.
Greg also CVS. You guys are both right. Ding, ding, ding.
Woo!
Round of applause.
Greg's
So
on.
what's the score? 3-1 James right now.
So James 3, Greg nothing.
All right,
Tie.
tie.
Evens out. Okay, last but not least, this is it. Market cap on this company, 4.05 billion. It's a little baby. PE of 58.48. Number of employees, 7,075. Annual revenue of 0.77 billion. Just barely hit the billion amount. It's got an earnings per share of 0.045, barely even positive. Is this company A, Hecla Mining, B, Home Depot, 3, Intel,
How many employees?
Home Depot's got more employees than that.
1,700.
Hector Mining.
I'm gonna go with that as well.
Okay, they both go with Hecla, Greg and James, and the answer is Hecla Mining, A.
Yes.
So, episode
The game
winner.
show ends. James, episode 1, Meeting of the Minds. James has beat me 3-0. We move on to the next segment.
Do you want to go a couple more to try to catch up, or?
No, we're gonna end it.
Okay.
Yeah.
We'll pick this back up in episode 2 and with more of the trivia stock game show.
All right.
And,
Episode 2, you will see the episode against me and Andrew in the stock picking game show. Moving on to the next sequence of the episode will be the insightful stock picks from our Meeting of the Minds creators, James and Andrew. So, Andrew, start off with the next segment and give us your number 1 stock pick and give us the reasons
Well,
why.
Greg, I appreciate that question. Again, for the audience, this is strictly entertainment purposes and for your knowledge to learn more about finance, stocks, and investing.
Not financial advice.
Not financial advice. Please consult a financial professional. Most importantly, if I was to give a stock pick in today's episode, I would definitely pick, in today's world, a gold mining stock. Defensive in nature. It's got strong earnings per share growth, strong revenue growth, and most importantly, protects you against today's difficult inflation. And to top it off, for your more sophisticated investors or long-term investors, also has a very strong dividend yield of topping maybe 5% yield on that dividend. That company is Newmont Gold. Ticker is NEM, I believe. Great company to invest in long term and would be a great add to your portfolio. With that said, I'm going to kick it over to Greg.
My insightful stock pick, guys, will be waste management. Number 1 reason, Stericycle sold out to them, which is insightful because I used to work at Stericycle and they had a monopoly on needles coming out of hospital systems and hazardous waste. With waste management buying their company out, they're getting a significant market share. Stericycle is a $3-4 billion company. If they can execute on the logistics side of holding in their accounts like hospitals and landfills, they're going to have a significant market share in the future. Right now, their EPS stands at 6.29, price to earnings ratio of 33, and the 1-year target estimate is 225. Great company. Hazardous waste in general, that's a very uncyclical industry. At the end of it, it's very defensive. They're always going to be top of the market. That's my number one insight for you guys. We're gonna move on to James, who's gonna give you his number one insightful stock pick right now.
Thanks, Greg. Well, I just wanted to say I like I do like the chart for Waste Management. Like it basically, it's kind of like McDonald's. You know, everyone keeps eating hamburgers. People keep taking out the trash. Like that's not going to stop anytime soon. So, yeah, it's in terms of risk, it looks like a nice pick. I'm going to go a little bit more on the aggressive side and looking for some deep value here, as they say.
Okay.
So, looking for a trend that maybe has been doing not so great for a while, but has to be turning around soon. And I think I'm talking about real estate. As we all know, for the past year, 2 years really, since 2022, we put interest rates at some of the highest levels they've been in a long time, and most people have a mortgage. I think it's like the stat is like 80% of Americans have a mortgage under 3% or under 4%. It's yeah, and so it's a lot of people. So nobody wants to sell their house right now because you get a low rate mortgage, and then you don't want to who wants to sell their house on a low rate to only to get into at 3% to get into a mortgage at like 7%, right? Nobody wants to do that. So no houses are being sold right now. We're at an all-time low of houses not like transactions not happening. And I think that's the time when you want to start looking at opportunities and say, well, this is going to turn around eventually. How can I get in now while it's not looking so good? And by the way, I did have a similar pick when COVID happened about the airlines, and I was right about that because the airlines crashed. I said, this is crazy. The airports are going to be crowded again. We need to buy the airlines. And it turned out to be right. But anyway, jump into my stock pick. I'm going to go with specifically Redfin. Rocket Mortgage is another good one too. They deal with more just mortgages, but mortgage rates have already started to go a little bit lower because they don't move exactly with the Fed funds rate. But in terms of real estate transactions, they're at an all-time low basically. So there's nowhere to go for them but up, and that's how Redfin makes their money. They make it off real estate transactions. Especially at another thing that's going on in the industry right now.
That's a great point.
Is the new laws for the National Association of Realtors, which may, and there's some debate on this, but it's looking like they're going to have to lower commissions at least a little bit. And if that happens, Redfin is well positioned to also take advantage and take more market share because that's their bread and butter. They've been doing real estate transactions for a low commission rate the whole time. That's basically their business model. And looking at the chart, because I'm getting into more of the technical. I'm more of a trader, a swing trader type of person, and it's been beat up. The stock's been so beat up. I mean, right before COVID happened, it was trading at $31 a share. At the peak, GameStop mania era of 2021, it hit over $95 a share at one point, and then fell all the way down to $3.08.
Wow.
So yeah, so right now we're looking at about $10.50 a share. We're down from hitting 15 a couple of weeks ago, and still looks to be on an upward trend. So I still think it's a good time to catch this thing and ride it out at least another 100%. I'm not saying it would be like a long-term investment, hold it forever, but at least hold it until real estate transactions are back at a normal level, and it should be much higher than it is right now. The market cap's incredibly small. I think it's under, it's in the millions, not even 1 billion, and which is crazy for a company of that size that does that many transactions. So anyway, long-winded answer, but I'm going with Redfin for my stock pick.
Wow.
All right. So folks, we're gonna accumulate all these stock picks. Next week in the next episode, episode 2, we're gonna see which percentage these stocks went up based on James' analysis, Andrew's analysis, and my analysis of Waste Management. Next time, the next part of the episode, we're gonna talk about specifically the IRA and how you can contribute to that IRA and over the long term be successful financially. So I'm going to lead it over to James. He's going to give you some insightful tips about the reasons why contributing to IRA is going to set you up for a success in the future. And we're going to ask him some follow-up questions. So I'm going to lead it over to James right now.
All right, good deal. Yeah, and the reason I think it's important to mention the IRA specifically is the IRA is a tool that everyone is able to use that can basically allow them to sort of let their investments grow tax deferred. And the IRS will let you put in up to $7,000 a year now, and that basically grows tax deferred. So in other words, if you sell investments and want to get into new ones, you don't have to pay taxes. It'll keep growing until you take the money out. You don't have to use an IRA. You can open up any normal brokerage account. It's just that every time you sell a position, any gains, you'll have to pay taxes on that on your tax form that year. But just generally speaking, I think what is really important to mention is people you need to get started. Like if you want to make money in life and you know have say $1 million or more in your lifetime, it's actually very easy. Like anyone can do it. Like you don't even have to be smart, really. I'll tell you exactly how you can do it. And the thing is, you want to start out early. The earlier you start, the better. So, for example, I think 22 is a good age to use as an example. 22 is college graduation age. I mean, if you don't go to college, then you have even more time to get going on this. So you should actually be ahead of, say, a college graduate. But say looking at age 22, let's say you invested $7,000 a year, which is, if we look at that per month, we're looking at $583
It's very
a month.
reasonable amount.
Yeah, it's reasonable, and we can definitely see. And by the way, we can definitely look at a lower amount too, and see how that would come out. But I'm just picking 7,000 because that's the IRA. That's what the IRS will allow you to put into an IRA every
To
single year.
maximize, maximizing that amount that they allow you to put in.
Exactly. So if you do that and assume an average stock market return rate of 10%, and we're talking just basic index funds, ETFs, S&P 500.
Is that a yearly return of 10%? Kind of rolling.
Right, and we can kind of, and that's more recent. Looking over, say, the past 50 years, or going back even further, historically they used to say 7, now it's 10. We can go ahead and look at both. Assuming the 10%, a 22-year-old, you deposit $7,000, right? By the time you're 32, you just keep doing that every year, once a year. Or the $583 a month. By the time you're 32, you have $129,000. By the time you're 50, you have $1 million. So literally all you have to do if you want it at one point in your life, have $1 million. Just invest $583 a month starting at age 22 into an S&P 500 index fund, and statistically, historically speaking, when you're age 50, you will have over $1 million. When you're age 65, retirement age, you're gonna have the number's gonna be 4.5 million, over 4.5 million. Let's be a little bit more conservative. Let's say instead of 10%, we assume an average rate of return historically of 7%. We'll bump that number down to 7.
That seems like more of a good conservative number. Taking into the fact that you do have recessions, and in some years will be lower at maybe 4%.
Exactly, and a lot of this happened over the last 50 years. We had the lost decade in the 70s, and with the tech boom,
Tech bubble
great
bursting,
financial
and real estate crash, and 08.
Right. So even if we just assume a rate of 7% return, so again, start investing when you're 22 years old, $7,000 a year. By the time you're 35, you get 158K. By the time you're 45, that's 407K. You reach $1 million at age 57, right? So you're still reaching $1 million by the time you're 60.
Wow.
I mean, it's really incredible, and this is just, and I can't say it's guaranteed, obviously, but historically speaking, this is what happens. And I hope we didn't lose anyone there when we said, because $7,000 a year is $583 a month. For a lot of people out there, I feel like $583 a month could still be a lot of money. And I don't want anyone turning this podcast off saying, "Oh, this is crazy. I don't have $583
Even if it's
extra to spend."
even if it's $50 a week, you invest $50 a week.
Right.
You get paid every 2 weeks, maybe $100 every 2 weeks into the IRA that James just explained. Has huge benefits or return on investment 20, 30 years down the line. Moral of the story is if you start young, stay disciplined, and invest a small amount of your paycheck every month, you'll have huge returns when you're heading towards retirement age.
Yep, I do agree. And let's actually, I like that $50 a week part that you mentioned, because for a lot of people, that might be all they can do is $50 a week. And I'm not, but not forever. Hopefully not forever, right? We want to get to a point where, if you don't like your job, you get in a better job. You're moving to a different industry or whatever. You're like, guys, we have to make moves. We have to actually care about making ourselves more successful, and we want to provide for our families. We want to help people.
Guys, we gotta stop. I wasn't recording the audio on it.
You were.
Yeah, just fucking shut it off.
Do you want to see if we can use that audio
Yeah,
from
we'll see, yeah.
from the phone, and then
Yeah.
Well, so what did we capture? Okay, let's
hopefully that's all right.
let's
Time out.
yeah,
Time
yeah.
out.
Time out.
Let's use that audio from the phone.
All right. Part 2 action.
Okay, back to where we left off. James was.
We had some audio issues there with the microphone. We're just starting out here, but yeah, we're gonna roll with the iPhone audio for now. Anyway, like we were saying, I liked your idea about what if it's only $50 a month. Guys, I don't care what your job is. Do $20 or a week if you can. Do something. Like if you spend money on something like going out to the bar, cigarettes, Netflix. I think anyone can afford to do $20, $50 a week. So if we change that number down to $50 a week, and assume on the lower end, average rate of return for stock market average of 7%. What age do you guys think? So starting at age 22, what age do you guys think you make $1 million at?
I would say age 42.
42.
I'm gonna go on the higher end, $1 million. I'm gonna guess
Only $50 a week. So
$50
that's $2,000 a year. $2,600 a year.
$50 a week. I would say age 60.
60.
I'm
Okay.
gonna go right below that at 58.
Okay.
Age 58.
It is a little bit higher, but I think the results are still pretty impressive. It is, and again, this is just, you don't even have to be smart to do this. Just literally take $50 a week, which is, these days, what is $50? Can you even buy yourself a meal at a restaurant with $50?
You spend $4 a day on a coffee. $50 a week is nothing.
So this age is a little bit higher, but just to illustrate the point, it's next to nothing, right? So $50 a week, starting at age 22, put it into an index fund or ETF, and at age 74, you will have, historically speaking, $1,022,695.85. So at age 74. Wow. So it's retirement age, but guess what? You retire with $1 million.
$1 million.
And obviously, over the course of your life, you're going to hopefully be making more money where you can do more than just $50 a week. So this 50 is going to turn into 100. That 100 is going to turn into 200. You know, get to a point where you're doing that $500 a week, and you're going to have over $1 million, well over $1 million by the time you're hitting retirement age. And again, this is not even talking about like business ideas, investing strategies. This is literally just
It's
like
very basic.
automatic, steady Eddie. Just do this. Just do it. Like
Yes.
there's no reason not to start, and it doesn't matter. You know, we really got to change the way people's minds are thinking, because you know, because of this happened to me in life, or that happened, or I have this background, or whatever. It doesn't matter.
And you know what? To give a great baseball analogy is, you don't need to hit a home run off the bat. You can keep hitting singles, and you hit a lot of singles through your lifetime, and they all add up.
So I have a great question for you, actually, James. Like, what's the difference between a Roth and a traditional IRA?
Sure, great question. They're both personal IRAs, and that 7,000 a year limit, which they do sometimes increase that over time. So by the time we're older, it's gonna be higher than that. But and you can split that up between traditional and Roth IRA. But to answer the question, the difference is what type of break the government gives you. So a traditional IRA, it's considered pre-tax money. So in other words, when you put money into it, you get a tax deduction. If you put in $5,000, $1,000, $7,000, whatever, you're gonna get that amount tax deduction that year. So you'll be decreasing your tax liability. Now, on the flip side, when you take that money out, when you're after your age 59 and a half, you can take the money out.
Yeah.
Then you pay the taxes. Basically, it's counted as income, and you pay the taxes on it. That's been the traditional way of doing it. But what I like better, and is the newer product that the IRS allows you to utilize, is the Roth IRA. And it's kind of like the opposite. It's instead of paying the taxes later when you take the money out, you're essentially paying them now, in the sense you don't get a tax deduction when you put the money in. It's considered out of pocket after tax money. So in other words, after you get paid, you put the money. You have the money in your hand, now you're putting it into the account. You don't get a tax deduction when you put the money in, but the awesome part is it's still gross tax deferred, and when you take the money out, it's tax free. So in a way, you never pay taxes on any of those gains in that Roth IRA account, which is amazing. So essentially, do you want to pay taxes now or later? Well, if you're young, I would certainly say it's a good idea to pay it later, unless you're in a situation where a traditional IRA is a better choice if you're trying to get a tax deduction that year. You need a tax deduction, or you're assuming that you're going to make less, and your income's going to be lower in the future. So say maybe you're like 60 years old and you're going to be retired on Social Security. Your income's going to be less. In that case, at that point in life, traditional IRA may be better. For basically anyone else, all the young people out there, all the people that believe they're going to have their income's going to be higher in the future, you want a Roth IRA, because you'd rather put in the money now that you've already paid taxes on, and then when you take it out, it's tax free.
That's a great point.
And again, the IRA is awesome. We could do like a whole episode on IRAs, but it doesn't have to be an IRA. This could be any account, and these are the types of returns that we're talking about here. So it just depends on when you have to pay the taxes. But I mean, really, guys, this is like an awesome thing. Everyone should be investing. I don't care, you know, how old you are, how much money you make, where you came from, gender, whatever. You should all be doing this.
I just wanted to ask one more question from IRA and Social Security standpoint. How should you coordinate with IRA withdrawals with Social Security benefits to maximize overall retirement income?
It's a detailed question, and the cool thing is there's actually tools out there that will calculate this for you. I don't want to say any names in particular, but just if you just Google, you know, retirement income evaluator tool, there's going to be a few things that pop up there, and you're going to input all of your personal, your income, expenses, what your assets are, what you expect to be, having to have as expenses when you're in retirement, and it'll automatically calculate a whole plan out for you. So there's definitely tools that are available online that can do all that. Yeah.
Yeah, do you have any follow-up questions for him, specifically geared towards the IRA?
Not necessarily. I think I think you really need to consider with the Roth IRA, if you're going to go with the Roth IRA or the normal traditional IRA, is how much money you're going to be making at retirement. Again, if you plan on having that high-end, high-flying career, making 250 plus a year, you would definitely be, you definitely probably want the Roth IRA to pay the taxes up front rather than the traditional, because when you start to withdraw from your normal, your Roth IRA at that high income tax bracket with that high paying job, you're essentially gonna, it's not gonna be as beneficial, and you're not gonna fully encompass all the gains from that Roth IRA. So take into consideration your income at retirement is huge on determining which route you go, whether it's a Roth IRA or a traditional IRA.
Yeah, and the more income you have too, you're gonna want to have and use more tools to help you out. Like, for example, with the Roth IRA, in particular, the IRS says that once you make over $161,000, you're not allowed to contribute to that, or $240,000 married. That's okay, because after you've already contributed to your Roth, you can go ahead and just contribute to regular non-retirement investment accounts, which don't have the same tax advantages, but you can still buy all the same investments and these index funds we're talking about, and do it that way. So there's always a way you can invest, and it's just looking at your personal income situation, personal financial situation, and finding out which way to do it. But the point is, just do it.
Yeah, and to James's point, there's many ways to invest. Another way actually is if you open up your own individual brokerage account, and your only source of income is via qualified dividends, and you don't have a job, you're not taking money in from a 1099 or a traditional job, those dividend income, the dividend income you collect is taxed at zero. That's if you were to open up a brokerage account and just simply collect qualified dividends off that account and not have a job. So that's another way to invest and possibly be successful in retirement, opening up an individual brokerage account in dividend investing.
Yeah, and we don't even have to just think about retirement, but it's cool to just like talk about retirement, because you can see how much money you amassed over such a long period of time. But it certainly doesn't take, it doesn't take until you're age 70 to, make a good amount of money. And there's lots of other more advanced things that we could, eventually we'll get into that you could do. But at a bare minimum, guys, just invest whatever spare money you have. Instead of, having that extra drink at the bar or cigarettes, whatever your thing is, buying another pair of shoes, clothes, just get some of that money each week or each month into an investment, into the stock market. There's ETFs out there, we got SPY for the S&P 500, the NASDAQ is QQQ, the Dow, DIA, you got the Russell 2000, IWM, and then there's index funds as well.
Yep.
Whatever floats your boat, go look into these things and just put some money away every single pay period.
Yep.
With Me of the Minds, we will make you successful. We'll bring insight, and we're gonna open your mind in terms of the financial realm, and we're gonna bring you value, folks. Tune into episode 2. We're gonna have one-on-one, me versus Andrew, in the
stock trivia
game. We'll have 3 insightful stock picks from our wonderful James and Andrew. And lastly, we'll focus on a specific focus within the personal finance realm with James leading us off, and he's going to go over some insightful topics, and we're going to ask him some questions. Tune into episode 2, guys. Me of the Minds. I'll see you later.
Thank you. Tune in again.
It's a wrap.
1,